In this section, we are going to discuss the transactions and accounting for purchases of inventory by a merchandiser. When we are recording the purchase of inventory, there is an overriding rule we need to keep in mind, and that is that inventory, which is an asset, is always recorded at its actual purchase cost. So for example, on June 20th, ABC buys $14,000 of merchandise inventory, paying cash. We would record this transaction as an increase to the inventory asset account, debiting it $14,000 and crediting cash to decrease cash $14,000 to reflect a decrease to cash as a result of the purchase. Something that can happen subsequent to the purchase of the inventory is a purchase discount. A purchase discount is one that is taken if early payment of invoice is made within a discount period. So if we look at these discount terms, we read them as a 2% discount can be taken if the invoice is paid in 10 days. If the invoice is not paid in 10 days, the net amount is due in 30 days. 2% discount if paid in 10 days, or the net or full amount of the invoice is due in 30. Because we do not know at the time of the purchase whether this discount would have been taken, we recorded the original purchase at its initial invoice cost. But we have to adjust the inventory asset when the liability to pay that inventory purchase is actually made at a lower price due to the discount. So if ABC purchases $27,000 of merchandise inventory, this time on account, under the credit terms 210 net 30. This means they get to take a 2% discount if they pay the $27,000 liability in 10 days, or they will pay the full amount of the invoice in 30. On May 7th, when they bought the inventory, they would debit the inventory account to increase it and credit the liability. If, within that 10-day period, ABC paid the amount due, here they paid on May 15th for the purchase on May 7th, we have to adjust the originally recorded inventory purchase cost. Recall we originally purchased and recorded a $27,000 asset. However, we are not actually paying $27,000 for that asset. We are actually only paying $26,460 because we took a 2% discount. $27,000 times 2% means we took a $540 discount. So when we go to pay off the liability, we are only paying cash of $26,460. The full liability is being paid off. We are paying off the full $27,000 we owe. So we need to decrease the liability by the full $27,000. The difference, or the discount of $540, needs to be decreased from the inventory account so that the inventory asset account reflects the actual cost of the inventory as the amount purchased. After these journal entries are posted, we will see that the asset balance is $26,460, which is the actual cost of the inventory purchase. And the liability is now zero. We no longer owe anything for that purchase. If we end up subsequently returning some of our inventory purchases, we need to decrease the inventory account and also decrease the accounts payable to reflect the adjusted cost of the purchased inventory. Because if we return inventory, we're no longer going to pay for it. So if on May 9th, ABC purchases $20,000 of inventory on account, credit terms are 210 net 30. The purchase journal entry will be a debit to the inventory account to increase and a credit to the liability account to increase. The next day, ABC returned $500 of that inventory to the supplier. We need to decrease the inventory account because we no longer have the $500 that we originally recorded as having been obtained. We are also going to decrease our liability account for the amount returned. We're not going to pay for inventory that we had returned. So finally, on May 18th, ABC paid the amount owed for that purchase, less the return of some of the inventory the next day. Because they paid within the 10-day discount period, they are going to take the discount off of what they now owe. So the original purchase was $20,000. They returned $500. So they now have a liability of $19,500. They're taking a 2% discount off of what they now owe, meaning they now are going to be paying cash of $19,110 to pay off the liability for that purchase. So we're going to credit cash for the amount of cash used to pay for the purchase. We are going to decrease the liability account because the entire remaining liability is being paid off. And we are going to decrease inventory down by the $390 discount off of the original purchase invoice. One other thing that can affect the cost of inventory subsequent to its purchase are transportation costs. There are two types of transportation shipping terms. FOB shipping point means ownership of the inventory transfers from the buyer to the seller at the shipping point. That means the ownership transfers as soon as the inventory is shipped and the buyer pays the shipping cost. If the shipping terms are FOB destination, the ownership of the inventory transfers from the buyer to the seller upon inventory reaching its destination. Thus, the seller owns the inventory while it is in transit, so the seller or the shipper pays the shipping cost. If ABC purchased $8,000 of inventory for cash and also paid $100 transportation costs because goods were shipped with the terms FOB shipping point. The FOB shipping point means ownership transfers as soon as the inventory ships. Thus, the buyer, ABC, owns the inventory during transit and is required to pay the shipping cost. So we would debit inventory for the $8,100, the $8,000 purchase cost, plus the $100 shipping, because the true cost of that inventory is $8,100. And we credit cash for the cash paid. Please note that shipping costs paid by the buyer on a date after the original purchase was recorded as an increase to inventory. To increase the cost of the inventory purchase, we would need to make an adjustment at the time that the shipping costs are actually paid. So here is a summary of the impact of all of these things on the amount we record in the inventory asset account. Recall the general rule that I gave you at the very beginning. Inventory recorded in the inventory asset account must always reflect the actual cost of the purchase. So the original purchase of inventory for ABC during the year may have been $692.5 based on initial invoices, but they took discounts for early payment of $10,388. So they decreased the inventory asset account for the amount of those discounts. They also returned $42.75 of inventory, which they would have decreased the inventory account for any returns and allowances. But they paid shipping of $4,895 on those purchases, adding to the cost of the inventory. So $4,895 would have been added to the inventory account as the transportation costs were paid. That means that the actual cost of inventory as recorded in the inventory asset account will be $682,732. Just remember, inventory asset account needs to reflect the actual cost of the inventory. So if something happens after the original inventory is recorded at the time of purchase, we need to adjust the inventory account up or down. We need to increase or decrease it as a result of discounts, returns and allowances, and transportation costs.